Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Over the past 3 weeks, our podcast focused on the outlook for 2022. This week, we extend the discussion to the fixed income asset class. For that, we turn to our in-house fixed income expert, Prerana Seth, who, by the way, is not new to this show. Prerana, welcome back. Let's start by reviewing the past 12 months. Talk to us about the performance trends of the fixed income assets during 2021.
One common aspect was the bond market volatility, which remained on the upward trajectory throughout the year. Bloomberg Barclays Global Aggregate Bond Index lost almost 5%, registering the worst performance since 2005. US Treasuries recorded the worst annual performance since 2013, the taper tantrum year. On a total return basis, long-dated bonds underperformed short-dated bonds despite the yield curve flattening. On the positive side, global inflation-linked bonds were the best performers, returning around 3%. In the credit space, global high yield recorded positive returns, with the US high yield index rising by 5%. While the global corporate investment grade declined by 3%. In emerging market dollar sovereign bonds underperformed local currency bonds and also the dollar corporate bonds, mainly dragged by the sell-off in the Latin American, Turkish and Egyptian dollar sovereign bonds.
Against that rather weak backdrop of the past 12 months, how do you see fixed income assets performing over the next 12 months?
The next 12 months could also prove to be quite challenging for fixed income assets. Inflation uncertainty could continue into 2022 with the emergence of new COVID-19 variant, likely to further delay the normalization of supply chain issues. However, the main dominant driver will be the central bank policy and its prospective impact on growth inflation. The Fed has signaled a gradual exit from its ultra-loose monetary policies by ending its taper in end of March and penciled in 3 rate hikes for 2022 in their December 21 meeting rate projections. The Fed minutes of the December meeting also revealed their willingness to turn more aggressive, even signaling the possibility of balance sheet reduction, especially if they are able to reach their employment goal. As a result, we expect the US Treasury yields to rise across the curve in 2022. We remain underweight on fixed income and maintain our short duration overweight stance on US Treasuries. And when it comes to yield curve, we believe it will be a year of two halves. Steepening in the first half, with the long end rates rising more, pricing in a longer Fed rate hike cycle, and flattening in the second half with short end rates rising faster if Fed becomes aggressive.
Prerana, what according to you are the key risks and challenges for the fixed income assets in the year ahead?
One thing is certain, that the Fed will be raising interest rates this year, at least by 3 times. Markets have become more aggressive, in fact, pricing in the possibility of 4 interest rate hikes. However, the biggest risk is that of a policy error, that is, if the Fed becomes too aggressive, ignoring the risk on economic outlook. If that happens, the yield curve could move close to inversion. While we do not anticipate the yield curve to invert as the probability of recession remains low, however, if inflation levels remain elevated despite Fed rate hikes at a time when growth is slowing, this could put the central bank in a growth inflation dilemma and pressure the financial conditions. We expect the financial conditions to come under pressure if there is more than 1% jump in real rates, either led by significant decline in break-even rates or alternatively by rise in long-term bond yields, or even both. Tight financial conditions could negatively impact the performance of the risky portions of the fixed income assets, including developed market corporate bonds and emerging market bonds.
Do you think everything is gloom and doom, or have you identified any bright spots within the fixed income landscape?
We believe that remaining selective is the best strategy within fixed income space, particularly within US corporate and emerging market bond space. As growth is likely to moderate in 2022, there is limited scope for spread compression in global credit. Higher carry should continue to attract investments into high-yield bonds, but given tight valuations, return from further price appreciation looks quite challenging. Given the Fed tightening risk and high vulnerability of low-quality bond to such risk, we recommend moving up the quality spectrum. In US investment grade, we favor AAA and AA, while in US high yield we prefer BB over single Bs and triple Cs. On sector level, we prefer energy, capital goods and financials in US investment grade and financials and communications in US high yield. Moving to emerging markets, valuation of emerging market dollar sovereign bonds have in fact become more attractive versus local currency and US high yield bonds after their underperformance last year. However, we still remain neutral on emerging market dollar sovereigns due to the Fed tightening risk, with selective preference for high-quality GCC, Russia and Brazil. In emerging market corporates, we retain our preference for Asia credit through our overweight stance on Asia investment-grade bonds. While Asia investment-grade bonds have returned to 2019 levels, they continue to trade attractive versus the US investment-grade and European investment-grade. And China's credit impulse is expected to start rolling over in 2022, which should prove quite supportive for Asia investment-grade bonds.
Well, it's always good to end on that positive note. Prerana, thank you very much for joining us this week. Thank you for listening to this podcast. We hope you found it useful. We would appreciate it if you can share it with a friend or a colleague. In case you'd like to get more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website www.adcbam.com for more information. You are listening to the Global Investment Insights podcast, and my name is Kishore Muktinutalapati.